Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at my dividend stock portfolio that has now grown to a value of $162,000. And in this October update, we're going to take a look at all my recent buys and sells, the dividend income I collected over the past month, the price performance of my underlying holdings, and all the market news associated with the top holdings within this portfolio. But before we do that, I am going to ask you to please hit that like button and subscribe. If you're new to the channel, I'm the Gen Z Investor, and I'm building up this financial freedom portfolio full of blue chip dividend paying companies that provide me with a growing stream of passive income each and every month. So this video is the October 2022 update for the portfolio, currently sitting at the exact value of $162,791. So overall, since inception, this portfolio is up 20.8% or $26,995 in share price appreciation. My dividends get automatically reinvested into my underlying holdings, so that gets factored into the book cost of my stocks at their current level, and this is the share price growth on the companies that I own. Overall, I own 22 different stocks within this portfolio. All of them pay a dividend, and every single company grows that dividend year in and year out. So in this episode, we're going to take a look at my recent portfolio performance, compare it to the relative S&P 500 to see how I did in comparison to the overall market, and I'm going to share with you all the passive income I collected and all my recent price movements and transaction history over the past 30 days. So if we take a look at Simply Safe Dividends, my portfolio value, like we saw, is just under $163,000. My annual dividend income that I will collect going forward over the next 12 months is $3,491, giving my portfolio a current yield at 2.15%. So this current portfolio yield is on the lower end, but I'm very early on in my dividend growth stage. I'm here for the companies that have a long-term growth trend and will be able to grow their dividend at a fast rate going forward, in comparison to companies who pay a higher current yield right now with lower dividend growth. I choose to invest in companies who I believe have very strong financial statements with the ability to generate growing free cash flow for many years going forward, and they have a very sticky business model. I like simple companies who operate in a way that I understand and have the ability to generate cash flow for decades going forward. And we can see, because of the dividend growth of my underlying holdings, my yield on cost on this portfolio is at 2.69%, and I'm a little less volatile than the overall market with a beta of 0.86. And because this is a dividend-focused portfolio, let's jump right into my October passive income report, and we can see this is a very slow month for the companies that I own. Different stocks pay out their dividends in different months, and we can see for the quarters or the payments in January, April, July, and October, only 3 of my companies pay out, and I'm going to collect $136 in passive income in the month of October 2022 from 3 different underlying holdings. The first one we'll go over is Kimberly-Clark, the consumer staple company. I own 29 shares for a total dividend income this month of $33.64. The second company is Toronto Dominion Bank, or TD Bank. I own 51 shares of this company, and the dividend income I'll collect is $35.06. And JP Morgan Chase, I own 68 shares. They pay out $1 per share per quarter, so I'll collect $68 in the month of October. So of course, dividend payments do fluctuate just based on when companies pay them out. We can see this is the lowest of the 3 options at $136 in comparison to March, June, September, and December, where I collect a lot more dividend income at $489 for each of those individual months. So not too shabby, $136 of passive income flowing into the portfolio without me having to clock in or do any work at my job. And if we take a look, 2 of my payments from JPM and TD actually haven't hit my account yet. I'm recording this video as of October 30th, and on October 31st, that's the payment date for these 2 companies' dividends. So on the next trading session, I'll collect $101 in dividends, and that amount will actually be deposited into my cash balance. And if we take a look at the next 30 days, Verizon, Lowe's, MasterCard, Apple, Costco, AbbVie, Procter & Gamble, and Visa are going to be the dividends I'm collecting going forward over the next month. And if we take a look at my dividend safety, I am a more conservative dividend investor. 89% of my dividend income is considered likely safe, and 11% is considered borderline. So I do not like investing in high yield companies that come with a lot of risk. I like investing in solid names who have high dividend safety scores and have the ability to continue to pay out that dividend and grow it every single year. So if we take a look at the 2 companies who are actually considered to be borderline safe, we have JP Morgan Chase and Bank of America. So my 2 largest financial holdings are considered to have somewhat risk associated with their dividend safety right now. Personally, I'm not too worried. I do believe in these companies long term. They have rebounded well since the pandemic. I don't think the upcoming expected recession will hurt them that bad, and I'm not too concerned about the dividend getting cut or reduced anytime soon. And if we take a look, JP Morgan Chase is actually the 5th largest holding in my portfolio in terms of total value, and I own over $8,000 of this company, so it is a significant part of my portfolio, but I'm not too concerned with the rating of their dividend safety score right now, coming in at a 60. And if we take a look, like I mentioned, I focus on companies who have the ability to grow their dividend at a fast rate year over year right now, as I'm in my early 20s and I have a long-term period of compounding up in my future. So if we take a look at my portfolio, this year the expected dividend growth on average across all my holdings is 8.5%, which is considered fast. And my 5-year average is at 9.5%. And for my portfolio, even though I haven't owned this portfolio for the past 10 years, if I had, the average dividend CAGR would be 9.2%, which is a very fast rate. And in the month of October 2022, 2 of my underlying holdings actually announced a dividend increase. The first was Visa, and they announced a 20% hike in their quarterly dividend, which is absolutely incredible. And the second was AbbVie, who announced a 5% growth rate in their dividend as well, to $1.48 per share per quarter. So overall, that is kind of a summary of my dividend portfolio. In the month of October 2022, I did not buy or sell any of my underlying holdings. So the actual makeup of my portfolio did not change. I just collected my passive dividend income over the portfolio, and the market did rebound very well, so that saw a nice increase in my share price of my underlying holdings. Pretty much all my companies have been up over the past month, which is a great sign, but overall nothing too exciting on the transaction side of it. Whenever I do make a buy or a sell in the portfolio, I will of course update you, and I'm most likely going to make a video of the specific company that I'm buying or selling to share my investment thesis on that company at the current point in time. But as of right now, for the October 2022 update, no buys or sells in the portfolio right now. And another important thing I want to discuss in this October update is that the top 3 holdings in my portfolio, Apple, Microsoft, and Pepsi, all shared their latest earnings over the past week in the last week of October. These 3 companies alone make up a third of my total portfolio's value. If you add up my 9.3% allocation to Pepsi, 11.9% to Microsoft, and 12.1% to Apple, that actually equates to exactly 33.3% of the total portfolio value. So I have a large weighting of my $162,000 into these 3 individual names, which is why I believe it's an essential thing to go over in the October portfolio update. So if we take a look at Pepsi, they did very well over the past quarter. Their stock rose after the earnings report came out. They beat on both the top and bottom line, and they reported earnings per share of $1.97, topping the Wall Street expectation of $1.84, so a significant beat on the EPS metric, and revenue for the quarter came in at $21.9 billion, beating the expectation of $20.8. And overall, something that was very important to notice with this latest quarter is that the company actually had lower volume. For the quarter ending September 3rd, revenue rose 9%, but they had a decrease in volume in their products in some of their largest divisions and units, including Frito-Lay. So that shows that the company was able to increase prices during this period of economic turmoil and actually grow revenue and sales during a point in time when volume decreased. That just shows how strong of a business Pepsi really is. During a time of economic downturn, the company has the ability to raise prices, and even though they sold slightly less units, on average units decreased by 2%, the company was still able to grow total sales by 9%, showing how consumers on the market are still choosing Pepsi products even during times of price hikes. And taking a look at Pepsi's stock chart, over the past month, they have grown by 9.66%, so it's been an incredible month for the company, and they currently trade at $182 per share. So that was the 3rd largest holding, and if we move on into stock number 2, we're going to take a look at Microsoft, who dropped by over 6% after their earnings came out. Although the company beat on total revenue and total EPS, their cloud revenue was lower than expected, and the market had a terrible reaction. So if we take a look, earnings per share for the overall company did beat the expectation, coming in at $2.35, and revenue for the quarter came in at $50.12 billion. So they beat the expectations on the top and bottom line, but why the market reacted bad was because the company forecasted for the next quarter between $52 and $53 billion in revenue, which implies only 2% growth. Meanwhile, the market was hoping for the prediction of $56 billion. And in the same quarter, the actual cloud revenue growth for the company slowed down. They still grew the Azure network by 35% year over year, but analysts were expecting 40% annual revenue growth, so that missed that expectation. And if you take a look at my previous video, I went more in depth on this Microsoft earnings because at that point it was the largest company in my portfolio. Apple has now slightly surpassed it because Apple has performed well over the month, and we can see that over the past 30 days, Microsoft is pretty much flat, growing by only 0.27%. So if you want to learn more about this Microsoft earnings report in detail, take a look at my previous video. And now if we jump over into the performance of the largest company in my portfolio, coming in at 12.1% rating with the value of $19,623, we have Apple, the largest company in the world. And if we take a look, they performed well, beating on the top and bottom line. But if we take a look, the market had somewhat of a mixed reaction to the earnings report. If we go over the numbers, earnings per share did beat like expected at $1.29 versus the estimate of $1.27. Revenue came in at over $90 billion for the quarter, beating the expectation of $88 billion. But what kind of created the mixed messages was the slowdown in their iPhone revenue, who actually missed expectations and only grew 9.67% year over year, and the slowdown in their service revenue, which came in at $19.19 billion, really missing the estimate of over $20 billion and growing by only 5%. So the service revenue, if you followed my channel in the past, you know I love talking about this part of Apple's business. This is the growth driver of the company going forward, has very, very high margins, very profitable, and has the ability to create considerate recurring revenue for the business. Apple's historical revenue model was selling physical products and hardware, which created one-time buyers, and then in a year or two down the road, hopefully those buyers would buy in to a new product. But with their new subscription services, the company will create monthly recurring revenue that has very high net margins. So that is kind of the growth for the company going forward. And that's where a lot of Apple investors, including myself, are looking for the high growth rate in the service division. So I will admit personally, I was kind of underwhelmed with only 5% growth in services. I'm hoping this is just a down quarter due to all the fear of a recession and consumers not, going out of their way to subscribe to new services. I do hope that Apple can kind of pick this up going forward and go back to the double-digit growth rates that we've seen over the past few years. And we can see in 2020, services grew by 27%. Then last year they grew by 16%. And overall for fiscal year 2022, they grew by only 14% overall to $78.13 billion. So we can see the growth rate is declining. I'm hoping they can bring this back up to around 14 to 15% on the next quarter, and that would make me really happy and actually more confident in their ability to grow over the long term. And if we take a look, if you're unfamiliar with the services that they offer Apple Music, Apple TV Plus, the App Store, different Apple products like Apple Fitness, and there's different subscriptions that continue to come out for the service each and every quarter. But one thing with Apple we have to note is because of the nature of their business, they have very high margins. And the company actually does a ton of share buybacks quarter over quarter, and they just set a record at over $25 billion spent buying back their company stock. So that's what I love to see. I love being an investor in a company that continues to buy back their own shares, which makes the shares that I own in my portfolio more valuable. And it makes it easier for the company to actually grow their dividend payment in the future because there's less shares outstanding for them to pay out the dividend to. And if we take a look over the past month, Apple is up 6.8%. So those were the three earnings report from the top three companies in my portfolio that make up a third of their overall value. I do believe it was an essential thing to go over in my October portfolio update. I think Apple had mixed reviews. I would like to see the service revenue improve going forward. I think Microsoft, the cloud revenue growth, although it missed expectations, coming in at 35% annual growth, I still like and I was happy with. And with Pepsi, I don't think they had anything negative to say about their earnings. Even though volume declined, which is never a good sign, it's kind of expected during the period of time we're going through. I think once we are able to recover, Pepsi's going to see exceptional results, volume's going to grow, and now with the increased price hike, the companies are going to generate greater revenue on greater volume, and overall I think it's going to be a great sign for the business over the long term. So that was a quick portfolio update for the month of October 2022. I do appreciate you tuning in all the way to the end. Please hit that like button and subscribe if you already haven't done so. On this channel, I continue to update you with my portfolio growth, and I talk about any major stock market news. So please hit that like button, subscribe if you already haven't done so, and I'll see you in the next video.